in this chapter include cost of capital components, debt, preferred stock, common equity, WACC, weighted average cost of capital, factors that affect WACC, adjusting cost of capital for risk. What types of long-term capital do firms use? Long-term debt. Some firms also use permanent short-term debt. Other firms have temporary short-term debt for seasonal fluctuation in inventory, but there is usually not a part of the capital structure. Preferred stock and common equity. Before tax versus after tax capital cost. Tax effects associated with financing can be incorporated either in capital budgeting cash flows or in cost of capital. Most firms incorporate tax effects in the cost of capital, therefore focus on after-tax costs. Only cost of debt is affected. Cost of debt. Method 1. Ask an investment banker what is the coupon rate would be on new debt. Method 2. Find the bond rating for the company and use the yield on other bonds with a similar rating. Method 3. Find the yield on the company's debt if it has any. Component cost of debt. Interest is tax deductible, so the after-tax cost of debt is the before-tax cost of debt times 1 minus tax rate. Cost of preferred stock. We can use this formula. The dividend of preferred stock divided by the price of preferred stocks times 1 minus flotation rate. Please be noticed that flotation costs for preferred stock are significant, so are reflected. Use a net price. Preferred dividends are not deductible, so no tax adjustment. Is preferred stock more or less risky to investor than debt? It's more risky. Company not required to pay preferred dividend. However, firms want to pay preferred dividend, otherwise 1. Cannot pay common dividend, 2. Difficult to raise additional fund, and 3. Preferred stockholders may gain control of firm. What are the two ways that companies can raise common equity? Directly, by issuing new shares of common stock. Indirectly, by reinvesting earnings that are not paid out as a dividend. For example, returned earnings. Why is there a cost for reinvested earnings? Earnings can be reinvested or paid out as a dividend. Investors could buy other securities, earning a return. Thus, there is an opportunity cost if earnings are reinvested. There are 3 ways to determine the cost of equity. 1. CAPM. 2. Discounted cash flow. 3. Own bond yield plus judgmental risk premium. Earnings retention model. Suppose that a company has been earning 15% on equity, or return on equity equal to 15%, and has been paying out 62% of its earnings. If this situation is expected to continue, what is the expected future gross dividend growth rate? Growth from earnings retention model can be calculated in the following formula. This is close to the dividend growth rate 5.8% given earlier. Determine the weight for the WACC. The weights are the percentage of the firm that will be financed by each component. If possible, always use the target weight for the percentage of the firm that will be financed with the various types of capital. The target weights could be set for 30% of debt, 10% of preferred stock, and 60% of common stock. Estimating weights for the capital structure. If you don't know the target, it's better to estimate the weights using current market values than current book values. Calculate the market value of debt if you have the information. If you don't know the market value of debt, then it's usually reasonable to use the book value of debt, especially if the debt is short-term. What's the WACC using the target weights? The WACC is the weight times the debt after tax, the weight of preferred stock, and the weight of common equity. What are the three types of project risk? Stand-alone risk, corporate risk, and market risk. How is each type of risk used? Stand-alone risk is easiest to calculate. Market risk is theoretically best in most situations. However, creditors, customers, suppliers, and employees are more affected by corporate risk. Therefore, corporate risk is also relevant. 4 mistakes to avoid. Current versus historical cost of debt. Mixing current and historical measures to estimate the market risk premium. Book weights versus market weights. Incorrect cost of capital components.